Our Region's Business is sponsored by PNC for the Achiever in You. Our Region's Business. Innovation, transformation, momentum, improving our communities and driving technologies that will shape our region for generations. The collaboration that brings vitality, prosperity, and life to living. Stay with us for the coming half hour as we examine in depth our region's business. Now, here's your host, Bill Flanagan.
Today on Our Region's Business, our region's personal connection to the first solar-powered flight across America. Plus, how open innovation is helping companies across our region reinvent themselves. But first, the global economic outlook. The world is still waiting for signs that the economic malaise caused by the Great Recession and ensuing crises is really over for good. Bill Adams keeps his pulse on the planet for PNC, where he is senior international economist. And welcome. Good to have you back.
Good to be here. Thanks for having me,
Well,
Bill.
perfect timing for your visit. Big news this week, a little additional volatility in the stock market after Ben Bernanke indicated the Fed may actually have a little bit of a change in policy looming out there.
It's been a big shift. If you're looking at the market reaction, it really started in May, but it's been, interest rates have gone up, I think, about 1/4 of a point since Bernanke's announcement. I mean, the signal that he's giving is not that much of a surprise. He said that the economy is slowly improving, and as it does, the Federal Reserve is going to take its foot off the gas pedal of quantitative easing is his analogy, but still leave it off of the brake of raising short-term interest rates. And so that's good news that the economy is getting better. That the short-term market reaction was negative, you know, it's a little bit of markets go up and markets go down, right? But
I guess, well, the stock market's had a heck of a run with this quantitative easing going on for the last few years.
It certainly has. And I think in addition to the U.S. stock market, this signaling of a change in direction for U.S. monetary policy also has had big implications for emerging markets. So if you're looking from Mexico to Brazil to India, elsewhere in emerging Asia, you've seen a sell-off of emerging market currencies as people have realized that this glut of liquidity, very low interest rates here in the United States was eventually going to, if not dry up, but at least shift in direction.
And so we've been in a period, where that's been adding sort of fuel to the fire of growth in the emerging markets around the world?
I think it has. If you looked around what emerging market policymakers have been saying, central bankers, they've all been talking about how difficult it is to manage the growth of their economies with U.S. interest rates so low. There's so much money being created by our central bank that not just affects our economy here in the United States, but has effects on what the availability of credit elsewhere around the world. And so with the Fed signaling that they're going to be shifting that gradually over the next couple of quarters, next couple of years, that the problem in the emerging markets is going to go from too much credit or having to slow down the growth of credit to possibly not having enough.
Wow, and so being able to maintain their growth to the extent that now the folks in those countries have sort of come to accept the fact that they have these dynamic growing economies fueled by this, that could change a little bit, right? A little new dose of reality?
It could change a little. I think in my point of view, it's still a normalization. I think the short-term outlook, the medium-term outlook for most emerging markets is still relatively good. With the Euro crisis ending, with Japan doing better this year, and with the U.S. still seeing moderate growth, I think it's a good environment for emerging market growth to continue. But just this problem of having to finance foreign borrowings and all of these traditional emerging market economic issues that had gone away while interest rates were so low in the United States are probably going to come back.
Yeah, not all that long ago, it looked like Europe was really teetering on the brink of another big recession. How has that's all stabilized now? That picture's brighter?
I'm not quite ready to use the word good or better. I think my phrase is still less bad in Europe. Okay. If you're looking at their economic indicators, it's still pointing to economic contraction probably in the second quarter of this year, but at a slower pace than they'd seen up until now. From sort of a bird's eye view or a 747 eye view, they've had two shocks in Europe. One was a financial crisis from the sovereign debt crisis, and then the second is they've had this huge shift in fiscal policy, raising taxes, cutting government spending, and that slows down growth, just as sequestration and the fiscal cliff have slowed growth here. So the financial crisis side of that has definitely eased, and that's causing us to see a return to some sort of growth probably by the end of this year. But the fiscal side continues to be a drag and is probably going to be a drag into 2014. So Europe is improving. I think it's a big shift, but the growth trajectory that they're getting on is still a pretty modest one.
Well, fascinating. You mentioned the sequestration, the fiscal cliff, all of that, and slower growth in the United States. Does that have global implications? It certainly doesn't seem to have. You know, the Fed's now able to back off the easing despite that. So it sounds like the overall U.S. direction is relatively healthy right now.
I think we're doing all right. The Fed has said in its latest policy announcement that they see downside risk to our outlook as having fallen since the last time they gave us a view on the U.S. economy. I think the concern that sequestration might push us back into recession or back at stall speed is definitely less of a concern now. But you know, it's inevitable when spending goes down and taxes go up, people have less take-home income. That definitely puts a pinch on household spending power. There's inevitably going to be an economic impact on that. I think what's outweighing that in the U.S., at least in the data we've seen to date, is that the housing recovery is so strong, fueled again by these very, very low U.S. interest rates. And so you have government as a drag, you have housing as a tailwind. You combine it and you get this moderate pace of growth, which we're seeing in the U.S. I think outside of the U.S., when they look at our economy, they're less concerned about, is U.S. GDP growth going to be 1.9% or 2.1% or 2.2%, and more concerned about will there be a debt ceiling fiasco that crashes U.S. capital markets or something. And the fact that that seems to be off the table now is very good for the global outlook.
Good for global confidence. Only a few seconds left, but I wonder, based on the announcements this week and yes, a little volatility, are we now beginning to see a moment when things might begin to look normal again after the last 5 or 6 years?
I think maybe. I think that the question is, what is normal going to be? And over the course of this crisis, we have seen the driver of global growth really shifting to emerging markets. I think that's probably still going to be the case. This year might be a little bit different with the U.S. recovering and with the U.S. dollar strengthening. But I think over the medium to long term, the emerging markets continue to grow and be a larger share of global output. And that's only going to continue.
Wow, fascinating. Bill Adams, Senior International Economist with PNC. Good to see you again. Thanks so much.
Thanks for having me.
Next up, a solar-powered airplane with a direct tie to our region. Stay with us.